So I forget, I'm a little bit different place with each of my classes here. Okay. So the last thing, I think, talked about this stuff, right? Advertising. Did I talk about this? Okay, so guys, this is actually the third cause of the Great Depression that I'll be talking about. So the first two, does anybody remember? Higher tariffs and war debts. This is number 3. Okay, so this is good. Wages rising 20% over the decade. Okay, that's great. Productivity was even better. It rose 40%. So we're building all this stuff, selling all this stuff, manufacturing it. Okay, people are making more money, which means they can afford to buy a lot of these products that are being made. Henry Ford had a saying. He said, the people that work in my factory are going to make enough money to buy the cars they're making. Okay, which is, I mean, that's kind of a cool thing. Like, so they make the cars and they make enough money to buy the cars. Okay, it'd stink if they didn't. You know what I mean? But the thing is, guys, productivity was so much that we were overproducing. So what happens is at the Ford the dealership, right, that sells the cars, right? The dealership this month didn't sell as many cars. So they tell the factory, say, hey, don't send us as many cars this month because we have a big inventory on the lot. Does that make sense? So when Ford starts getting messages, hey, slow down, we don't need as many cars, what happens back at the factory when they slow down? You got to lay workers off. You got to slow down, which means there's even more people that can't afford to buy the products that have already been produced. So whether it's washing machines, vacuum cleaners, toasters, phonographs, radios, so much production, and then by 1927, we actually start to see this, a slowdown, okay? But the stock market keeps going up while the gross domestic product starts to slow down, okay? And so people don't have enough money to buy all the goods that have been produced. And then that kind of spirals downwards. So you lay off workers, then you have fewer people that can buy, then you slow down production more, and then you have even fewer people that can buy, slow down production even more. You see it's a downward spiral. With me on that? You gotta kind of understand that concept. Okay, so this is a 1920s radio. There's some magazines, billboard examples here from the 1920s. And then I just did this in here because it's kind of fun. And that's my first car. Okay, 1977 Lincoln Continental. Okay, 2-door with the white top. Got these covers over the rear wheels here. They're pretty sweet. Doors are about 6 feet long, weigh about 200 pounds each. They're huge, okay? We used to call this the yellow submarine, okay? The headlights pop open like this. It's pretty sweet. It's got a 460 in it. It's a big old engine, man, okay? Ended up blowing the tranny in, doing reverse drops. You guys know what a reverse drop is? You get it going backwards, and then you drop it into low and hit the gas really hard, and you spin out. It's kind of rough on the transmission. But that was a good car, man. This thing would just float, man. It was a great ride. It was awesome. I don't know if you've ever driven a big car. They don't make them this big anymore. Okay? I mean, think about it. Are there any like really long cars like this anymore? Yeah. So Cadillac used to make them big, but this is about as big as they got. Okay. 2 big benches. We fit 13 people in that once. The yellow submarine. Okay. And then the music, like, did I go through, like, so we started with, albums, but then they made 8-tracks. Did I talk about that? 8-tracks. Any guys ever seen an 8-track? You know what I'm talking about? Okay, they're kind of cool. They're like cassettes about this big, and you put it in there. The cool thing about 8-tracks, you could skip to the next song. Then they came out with these cassettes, okay, and you couldn't skip to the next song. So you had to, like, fast forward or rewind it. to get to the song you wanted on the cassette. And then they went to CDs, and you guys have all probably had CDs, right? Okay. I mean, you know, there's going to be a day here, not too long from now, when they'll be obsolete, right? They're kind of now, because everybody's gone digital, right? I mean, I've Spotify, Pandora, Apple Music, Amazon Music, right? You guys use that stuff, or you listen to radio. Does anybody listen to the radio anymore? I do too, especially like AM. But I have Sirius XM in my truck, so I went ahead and got a subscription to that because there's so much programming you could listen to, and I drive a lot, so it's nice, you know, especially on road trips. I mean, you can listen to the news and all different kinds of stuff. So, yeah, that was a good ride. My dad bought it from an old lady. It's a '77. It was like '85 when he got it for $2,000. It's a pretty good deal. This lady couldn't drive it anymore. I drove it for a few years. It's kind of embarrassing driving around in that in high school, but I imagine some of you guys drive embarrassing cars too. Anybody still drive a car where you have to actually roll down the windows and up the windows, roll up the windows? Isn't it weird how we still say roll up the windows, roll down the windows? Okay, this is module 18. I'm gonna put these notes up here for just a minute and let you write them down, okay? Because we won't go past this slide today, okay? I'm gonna talk to you guys about how the stock market works and about just the basics of investing, okay? So I'll let you write that down, give me a minute. And then once I explain what I talk about today, this will all make sense. I'm just having them right. Sheep. So I'll be gone again this Friday. Sorry. But my daughter played another tournament this weekend in Illinois, and she made the all-tournament team again. So two tournaments, two all-tournament teams. So I gotta go. You guys get it, right? Okay, so stock market. All right, let's talk about this a little bit and kind of discuss, how this thing functions. Okay, you've got privately owned companies and publicly owned companies. Okay, so privately owned companies like Koch Industries, the Koch family owns all the stock in the company. Okay. Private or publicly held companies, so like Mark Zuckerberg, right, started Facebook, okay, ran that by himself for a long time, and then he went public. Once you go public, you start offering shares of stock to the general public. Now, if Zuckerberg holds on to 51% of that stock, he has what's called a controlling interest. He gets to decide what the company does. If he gives up that controlling interest under 51%, he hires a board of directors and a CEO to run the company. So the job of a CEO, guys, of a publicly traded company is to create profit for that company and its investors. So when you invest in a publicly held company, you are buying stock in a company that you hope is going to make money, that the outlook for that company moving forward is good. You follow me? You don't want to buy stock in a company that's going the wrong direction. Like, I don't know, McDonald's. Now, people are thinking about eating more healthy, right? But I don't know. You drive by the drive-thru at McDonald's in the morning, it's packed, right? Now, Chick-fil-A is packed every day they're open. You know what I mean? That's a good company. Now, I don't know if that's publicly traded. I don't know if that might still be a private company, Chick-fil-A. I don't know if they offer stock, okay? So those companies' job is to make money, okay, for the investors. So once you participate in this economy, this part of the economy, you want economic growth, okay? Now, guys, this is the stock market from 1934 to 2015. It has grown between 6 and 12% over time. How many of you guys have a savings account? What kind of return are you getting on your money there? Less than 1%. Okay. Now, interest rates are going up, so you should actually start to see your interest on your savings account make a little bit more money. See, guys, you are loaning your money to the bank. The bank takes the money you have in your savings account and loans it to other people. When interest rates are really low, banks aren't making a lot on interest, neither are you. But as interest rates go up, banks make more money on that interest. They don't give as many loans because people don't borrow as much money. You follow me? But you can get a higher rate of return. Not much. Okay, guys, you are not going to build a nest egg for retirement using a savings account in a bank. How many people, when you guys don't want to work anymore, say you're 62 or 65, you don't want to work anymore, how many of you guys want to have a nice big nest egg that you don't have to worry about money and you can go do some fun things when you retire, like travel? Who wants that? Everybody wants that. So guys, you got to play the game. You got to put your money to work for you. Just working a job for 45 years may not be enough. Okay? Now, the stock market in 1929 looked like this. Pull this up. It's in the, here it is. Yeah, this is 1920s. Okay, so starting back in about 1921, okay, you can see the market. This is 1923, 25, you start to see it go up. It's a pretty dramatic increase. Then it drops a little bit in 27 and 28, guys. It goes bananas. Okay, remember, I just talked about this. By 1927, we were starting to see a slowdown. But the prices of stock kept going up. And look at this. This is a matter of a few months. This rise is crazy. More and more people started thinking, I can get into this market and make money. So people that hadn't invested back in started to invest. The economy was good. People were making more money, right? The wages were going up, and people were like, I'm going to take my wages and invest it in the market, not really paying attention that the economy was actually starting to slow. So they weren't looking at the value, but the price. And the price kept going up, and people wanted to get in on that. Okay? So this is, there's a little hiccup here called Black Tuesday that we'll talk about. Actually, it comes down here and then goes back up, and then this is Black Thursday. Okay? Now let me show you this year on the market. If I can find this. Okay, this is this year. The market's down almost 8%. Okay, so the nest egg that my wife and I, your parents, have been trying to build if they're in the market has gone down 8%. Which means you're making more in your savings account as a percentage than I am. Okay. However, guys, every time I get a paycheck, I invest money in the stock market. Okay. In two different ways. One, through my employer in a 401k, and two, in private investment accounts. So I was buying when it was here. So whatever I bought here has increased in value. Does that make sense? This is for the long term, guys. So this is long-term investing. So when you retire, the younger you are, the more risk you can take because you have longer to recover from that risk. So, you know, if you bought here and you lost, you've got time to recover. Does that make sense? Okay. Now, let me go to the max that this will show. And I had a good question actually this morning. This goes back to the 80s. So 1988, I started investing in 98. That's when I first started putting money in the stock market. Okay. Pretty good time to start, wouldn't you say? I wish I had a lot more money to invest in 98. I was working my first year teacher with a measly salary, so I wasn't putting that much in. You understand? Okay. So let me kind of explain this to you. Today, people have 401ks. Okay, so that's how this has gone up so much because 401ks became a thing. Okay, so I don't really have room to write on here, but we do this. Okay. Now, guys, back in the good old days, when Grandpa went to work for a company, Grandpa would stay with that company for 40 years. People stayed, they didn't change jobs a lot. And a lot of those jobs offered their employees what were called pensions. Okay, so when you retired with your pension, you continue to get paid until you die. Not the full salary, but usually close to like 60% of what you were making. Pretty good. You add Social Security to that, you're living a good life in retirement, okay? But guys, pensions have gone away. When my wife started working at Coke in 95, they still had a pension. If you were hired into Coke today, chances are you're not getting a pension, you're getting a 401k. Big difference, okay? Now, 401k is a good thing. Pension is better. So if you guys get out of college and you got an employer and say, hey, we have a pension, not a 401k, a pension, jump on that job, okay? Because really the only people in most places today that have pensions work for who? The government. Whether it's parks and recreation. Ever seen that TV show? Okay. You get a pension. Okay. You can be a bumbling idiot and work for parks and recreation and get a pension. Okay. Or you could be a teacher in the state of Kansas and you get a pension. It's called capers. If you work a certain number of years, you get full pension. Okay. Now, have you noticed we've got a lot of new teachers, right? Including your sister. But most of the new teachers we have are not young teachers. They're old teachers. Right? Have you noticed this? So like Miss Barrientos, she left. She's teaching in Goddard now. She's making more money, yes? Well, teachers that are retiring from Mays and Mays South are now teaching here at Bishop Carroll. It's called double dipping. They put in their 30 years with the state. They retire. They start receiving their pension. Then they come work here at the private school, and they get that salary. So what they're doing is they're double dipping. They're raking it in before they retire. They're getting paid twice a month by two different places. Does that make sense? So Mr. Kennedy, you guys remember him? He was a double dipper. Okay, he taught in the Derby School District for 40 years and then came and taught here. Okay, we've got English, science, a bunch of them that are double dipping. Okay. Nothing wrong with that, you know. And it's kind of nice. You're an old teacher. You've been doing a long time in the public schools. Now you come here. It's freaking great. You get to deal with you guys instead of the public school kids. Great. It's an easy job. Seriously, right? Especially if you're old. Okay. Now, so 401k. Guys, hopefully the first good job you get. Anybody working got a 401k right now? Okay. Some employers offer it. Like some people, like if you worked at Quick Trip, you might be eligible for a 401k. Okay. So this is how a 401k works. I put up 5% of my paycheck every pay period. The diocese matches that. Guys, this is free money. Okay, if you don't do the 401k, you don't get the free money. This stuff will be invested in the stock market. Okay, so listen, I'm on my 25th, this is my 25th year teaching here. So I started in 98, 24 years, I've been fully funding my 401k. Curious about how much money I have in there after 24 years? Not as much as you would think, because my 5% is not very much. You understand? Now, my wife's 401k at Coke, her 5% is a lot more. The 5% that they add, which I think is 6%, is a lot more. And they actually know how to manage money over there. They have people over at Coke Industries that know how to invest. The diocese, our returns are not very good. I got about $140,000 after 24 years. Can I retire on that? For like 2 years. Yeah, so guys, I got to keep working. Now, and it's going down this year, it hasn't. 7%, my nest egg. Okay, so hopefully by the time I'm ready to be done teaching, I'm not ready to be done. That's back up. You know what I mean? And then I can put it in a safer place. So, okay, I'll talk about where this money is invested a little bit more. Okay, so let's talk, yeah. It's a tax fund. It's like a retirement fund. It's classification by the IRS. So as a religious school, they used to be actually 403B is what it was called. And then we switched over to 401k. The laws changed, and we were allowed to switch over to 401k. It's just a IRS term. Now, so let's talk about buying stocks on your own. Just like you want to be a day trader, okay? You download the app and you start buying stocks. And you're trying to make money in it quick, get rich quick type thing, okay? Now, let's take a company like Boeing, which everybody knows about. Boeing makes airplanes, right? And guys, one of the perks of sometimes working for a publicly traded company is they will offer you stock options to the employees, which means they'll sell you the stock cheaper than the general public can buy it for their employees, which is a nice gig. Yeah, that's a pretty sweet deal. So a lot of people take advantage of that if they work for a big corporation. Okay, so Boeing, let's say Boeing is trading for $50 a share. Okay, so let's say you have $1,000 you want to invest in the stock market, and you're going to buy Boeing. With me? How many shares can you buy for $1,000? 20 shares, okay, or $1,000. Okay, so you got 20 shares of Boeing. Now, Boeing makes 737, 747, 757, 767, 777, right? And let's say China Airlines orders 50 aircraft from Boeing to be delivered over the next 10 years. This is freaking great news for the people at Spirit and Boeing. Their jobs are safe. 10 years. You know what I mean? This is good. And they're going to stay busy. Okay? Now, one of the most popular planes over the last few years that Boeing was making was the 737 MAX. Now, before the MAX had some issues, they sold a bunch of them. So you get an order for 50 planes. Now, your stock, when you bought it, was selling for $50 a share. It's going up because they just had an order for 50 aircraft. So the stock is now trading at $60 a share. Okay, 60 times 20, right? You have 20 shares. You just made plus $200, right? So now your investment is worth $1,200. Did you have to get out of bed that morning to make $200? Did you have to go to work to make that $200? No, man. You could have stayed in bed in your pajamas and you made $200. Good stuff, right? Then, what happens to a couple of the 737 MAXs? Yeah, they crash with people on board. This is bad. Something's wrong with these planes. It's the software. It's not pilot error. It's the software is telling the pilot the wrong information. This is bad. Guys, the FAA, Federal Aviation Administration, is going to ground every 736 MAX in the United States, and then that will spread worldwide. Holy crap. This is like really bad news for Boeing. You understand? They're grounding all these planes. And so those new orders that you got to stop production. You got to figure this out. So you hear about this story at about 10 o'clock after the second one crashes, okay? And you call your broker, you only have 20 shares. So your broker's not really worried about you because you only have 20 shares. They're worried about the guy that has 10,000 shares of this. You understand? And the guy with 10,000, the broker doesn't even have to, he doesn't have to call the broker. He's like, I sold that for you at $58. Okay, but you, the little guy with 20 shares, you call your broker the next day, not the day of, the next day, he's trying to sell your 20 shares. And guess what? Nobody's paying $60. Nobody's paying $50. You're like, can you sell it for 50? I'll get my money back. Sorry, man, nobody's buying it. Sold it for 40. Now, you originally had $50 a share, so you just lost $300. And you lost $100 of your initial investment. Yes? Okay. Somebody came along and said, you know what, Boeing's going to get this figured out. They're going to get it fixed and they'll sell those planes again. I'm going to buy this at $40 a share and I'm going to make some money on it because it's going to come back. You with me? Okay. So, guys, this is the proverbial don't put all your eggs in one basket type thing. Okay. And here's a big reason for that. I don't know if you guys have ever heard of this company. Probably not. Called Enron. This was the 6th largest corporation in the world in the early 1990s. Large conglomerate of a bunch of different businesses. They offered their employees stock options. So if you work for Enron in Houston, which was where their headquarters were, and you bought their stock, so say Enron was trading for $100 a share, they offered to their employees at $80 a share. So many of the Enron employees, I mean, as soon as you buy that stock, you make $20 per share. Follow me? It's a great deal for the employees, but the catch is you can't sell for 5 years. You got to hold on to it for 5 years before you sell it. So the company was using their employees to help fund the company. And what the CEO, a guy named Kenneth Lay, was doing was cooking the books. You know, you got assets, you got liabilities, you got profits, you got losses, right? Guys, he was cooking the books. The liabilities of this major corporation were way higher than what they were reporting to the SEC or investors. Word broke on this. Enron was way in debt, way more than they could handle. The company's stocks started to plummet. Charges were brought up against the CEO. He went to prison, died about a year later in prison. The guilt. The employees could not sell their stock. The executives could. So within a matter of about 6 months, went from the 6th largest corporation in the world to 2 computers in an office. That was all that was left of the company. It went bust. Okay? That's why we don't put all our eggs in one basket. Okay? Because of things like Enron. It's amazing to think like something like that could happen, but it has. Okay? Now, one of the things you can do, does anybody know what it's called? You can buy something that helps diversify your portfolio. An index fund or mutual fund, which would be an index fund that covers kind of a broad sector of the market itself. Okay, so mutual funds, and yeah, I can describe an index fund here. Okay, so the New York Stock Exchange has 3 exchanges. It's got the Dow Jones, it's got the NASDAQ, and the Standard & Poor's, S&P 500. Okay. Then you have the Chicago Mercantile, which is where you trade commodities. Your hogs, your cattle, your beef, right? Wheat, corn, all soybeans, all that is traded on like the Chicago Mercantile. Okay. So that's another investment you can make, as is real estate. Yes? Sure. Okay. Yeah, so there's lots of different places you can put your money, guys. But if you want to get into the stock market and take advantage of that 6 to 12% over time, this is a smart way to do it. So an index mutual fund would look something like this. 6%. Now you got to have about $2,500 to buy one of these. Okay? You can go to Edward Jones, Charles Schwab, and there's an Edward Jones on every like street corner, right? All right. You go in there and say, hey, I'd like to invest some money. Okay, and they'll set you up with a mutual fund. All right, 6% goes to Microsoft. You own 6% of your $2,500 in Microsoft stock. 6% Walmart. 6% Pfizer. They've had a couple good years, haven't they? 5% Amazon. 5% Ford Motor Company. 5% in Boeing. 5% in Walgreens. 4% Coca-Cola. 4% in McDonald's. Okay, and you should go up to 100%. Okay, some of these funds may only have 2% of your fund in a different stock. Okay, so if Pfizer has a good year, but Ford Motor Company has a really bad year, they balance each other out. That's what an index fund does, or a mutual fund does. Mutual funds can focus on different sectors of the economy, like banks, like you can invest in banks. Now is probably not a great time for banks. The last 15 has been a really good time for banks. Before after 2008, I mean, that was bad time, and then it got better. Okay. McDonald's is trying to stay relevant, right? Going breakfast full menu all day. Okay, they're switching over to that. If you like breakfast for dinner, it hopefully keeps McDonald's going. But you want to invest in companies that you think are going to grow, and hopefully Edward Jones and whoever your investment advisor is will steer you in the right direction. Okay, with these types of things. So I would say between my wife and I mean, we probably own, hundreds of different funds. So if you come over here, the job you work for, if you have a 401k, for the diocese, we have 4 options. Okay, large cap, which are large companies like these. Okay, small cap, which would be like emerging companies, new companies that show growth potential, international stocks, and bonds. Bonds are your safest among these. So when you're young, I mean, go crazy here, right? 50% of your money goes there, okay? 25 here, 25 here. These are more risky than these large cap. These are established, strong companies, okay? These, more risk. Okay, so you get a higher rate of return. If a small company grows and becomes a big company, i.e., if you invested in Amazon 15 years ago, you might have a 1,000% return on your money. 1,000% return on your money. Or Apple back in 1980. You know what I mean? Think about that. You've seen Forrest Gump. Yeah, and some fruit company. Yeah, exactly. So, look, guys, it's within your ability to, like, what do you think's going to be the next big thing? You know what I mean? And then you can do private investing, like, hey, I got a buddy that's starting a company. You're going to help him get off the ground, invest in him. That'd be pretty good too. Okay. So, now, guys, here's the thing. If you do this, if you invest $2,000 a year from the age of 20 to the age of 65, you will have a nest egg of over $1 million. It's about starting early, okay? Because you have compound interest over 45 years, guys. Okay, if you can start early. Now, I didn't start early. I never made any money until I got this job. I mean, I made some money, but not enough to like really invest much. So if you can do that, now let's say you're in your first year out of college. You get a good job. Got a good job lined up yet, guys? What are we going to do? If you're a registered nurse, can you make $50,000 a year? Yes. Okay. If you're a home health nurse, if you do enough visits, like you work your butt off 60, 70 hours a week making visits, you can make $50,000, $60,000, $70,000 a year as a home health nurse. You just got to work your butt off. Okay. If you get a degree in engineering, you're going to make $50,000 your first year? More than that. Okay? What are you going to do? You're going to get a business degree? You're going to get an MBA? What are you going to do? What are you going to do? You got to think about this stuff. Okay? You're going to be a teacher? Okay? Now, if you work in the public schools, you start, I don't know, $30,000, $38,000, $40,000. Start here. You can ask your sister. I already know. But it's not very much. First year. Okay? So, guys, what you want to invest in is this. In addition to your 401k, you invest in what's called a Roth IRA. Okay? They put this in, this Senator Roth came up with this idea. They want people to save and invest for the future. Because Social Security, guys, may not be there. Okay? And it may not pay as much, as we hope it would. So, the thing about a Roth IRA is you're going to be in mutual funds. You're going to need about $2,500. Okay? The max you can do in a year is $6,500 a year. That's a lot. If you can do this, once you get your first job at 22, 23, max out your Roth IRA. Guys, when you get this money out at 62, tax freaking free. They cannot tax the capital gains that you make over 45 years on this. It's called a Roth. Okay, remember that. First, if you go to an investment advisor, they're going to tell you about the Roth. Okay, it's the first thing you're going to do. Okay, so every pay period, guys, I have money come out of my check that doesn't go to my 401k, that goes to my Roth IRA. Okay, and I can put in this much a year, which I try and do. Okay, my wife, she makes too much money. They told her, IRS said you can't, people over a certain amount of money can't do the Roth. You get hosed on that. Okay, now she has Roth from when she made less money, so she still has an account. And our guy's pretty good about like moving some stuff around and putting a little bit more of her money in the Roth and stuff like that. But then, guys, on top of that, we have a traditional IRA that we fund as well. So we're doing three different things. Both of us have 401ks. Both of us have Roth. Both of us have traditional IRAs. Okay, and she has a pension from COVID. And a pension from her first job in Louisiana. So, guys, my wife could retire. She's a couple of years older than that. She could retire. She's got enough money. The big thing is the bridge for healthcare. So if I keep working and I get healthcare, for her, she could retire. She knows that. She's not going to. She likes her job. Even though she's going to be gone Monday, Tuesday, Wednesday night this week, traveling for work. October's going to be busy. So, but she's going to pour a lot into that work, and when she finishes the job on time, under budget, she's going to get a bonus, which will be hopefully more than I make in a year. I'm not kidding, dude. She's a project manager, dude. Ladies, you can do this. You like math? Are you good at math? If you're good at math, you can do this. You can be an engineer. You guys know that, right? That's why I'm looking at you. All right, kids. Have a good one. Peace. Uh-oh.